I've met people before, every once in a while. Thankfully, it's less often lately, but there are some people who still say this. If you earn more, you'll get bumped up into another tax bracket and you'll get taxed more and it'll be not worth it because now you're getting taxed way higher. So, tax rate schedules and tax rate brackets, the way that they work is not like that. The way they work is you get taxed a certain percent on income, and then as you move up in income, the income above that moves into a tax bracket higher and gets taxed at that rate. It's called a marginal tax. A marginal tax rate means that the entirety of your income's not getting taxed all at the same rate. So for instance, last year it was around 13,000-ish for the initial bracket. That initial 13,000-ish gets taxed at 10%. Well, then say you earn some more and you get up to, I don't know, let's say 90,000. Well, you're going to be taxed higher. You're going to go up after that initial 13,000-ish being taxed at that 10%. The next bracket up would be the 12%, and you're going to get taxed, say, let's say to 40K. I'm totally making these numbers up. They're not exact. So 12% is going to be taxed from 14,000, 13,000, where that switches over to the 40,000. Then 40,000 switches over to the 41,000. So then at that switch over, you're going to start getting taxed at the 20%. And then it starts being 22%. And then 24%. Anyway, this is all made up numbers. It goes up to 37% for the highest tax bracket, which I personally think is way too low for how wealthy some Americans are. It needs to be much higher. But in reality, all of those tax brackets need to not be the highest tax there is. What really disturbs me is how low capital gains are taxed. Passive income should be taxed at a much higher rate than income. The big thing, though, is that each one of those brackets only taxes that percent on that section of income. So you're not going to get taxed. Say you have $100,000. You're not getting taxed at 24% on the entire $100,000. You're getting taxed at 24% on the $10,000, $90,000 to $100,000. That $10,000 is getting taxed at 24%. The entire rest of it is not. It's all in sections that way. So if you're earning more income, that helps you. There's somehow, somewhere, some way, this misconception that got out there into the world that if you go up in tax bracket, you get taxed higher, but it's a marginal tax rate, which means only a marginal amount of the money that has been brought in is getting taxed at that tax bracket. The other thing is your tax bracket gets dropped quite a bit because you're only getting taxed on your taxable income. Whatever deductions that are possible for and from AGI happen first, and then you have taxable income. For AGI is before your AGI is figured out, and that means exclusions. Say you have municipal bonds. The interest on that is not taxed, so that's excluded. But say you had some healthcare costs. Well, the healthcare costs might be deductible, but that would be from the AGI, not for it. Once you have all of those deductions and exclusions all finished and taken care of, you have your taxable income. Your taxable income is not all of your income that you've ever gotten the whole year. And on top of that, once you get done figuring out your taxes, then there's tax credit. And tax credits are things like the child tax credit. There's ways to reduce how hard you get hit even as you go up in income. It is true that the higher you go up in income, the more of your wealth gets taxed at higher rates. But you also have more wealth. And none of the tax rates are ever going to take away all of the wealth. You will always have earned more than you spent in taxes. You could earn $250,000, and yes, your taxes on that would be higher than $100,000, but the $250,000, you're still going to end up with way more money than the $100,000. You could even say the difference between $200,000 and $250,000. You're going to end up with more money in the long run with the $250,000. Now, you might spend more. your lifestyle might change, and then you don't have as much money, but that's not taxes' fault. Taxes are way too complicated in this country, and they're way too giving of corporations. Corporate taxes are extremely low, and if any taxes need to change and be made worse, it is corporate taxes. Corporations make out like bandits in this country, and that's really sad because people are real and corporations are artificial, and real living earthlings should have an easier time of it than invented concepts, ethically speaking. But unfortunately, that's how it works in this country at the moment. But as far as income goes, don't put limits on yourself for your growth or your earning potential. The higher up you go in income, yes, you go up in tax bracket, but those brackets are not like a universal tax for all your income. It's just for that section. Every once in a while, someone gets right there, right close to the edge of where a crossover is. Say before they were earning 90,000 and they were right at the top of the tax bracket, and then they go to 92,000, and so that 2,000 now got taxed at such, that new marginal rate, and that 2,000 feels like basically nothing because it basically is nothing. You do want to go up a tax bracket by, like, say, at least 5K, at least 10K, something like that, if you can. But in actuality, you're still technically making more. It's just a really small amount. You're not losing by earning more income. Capital gains is taxed way lower. So transfer your income into investment and get assets. Start appreciating value on assets. Start gaining compounding interest on investments. And your taxes will drop way down because they get a preferred tax rate. Even if you're insanely rich and you somehow manage to write off all these different things, there's still a minimum 3.8% tax. And people do, when they're extremely wealthy, get around that tax. Sadly, they get around that tax because they go into debt. And then the debt is not considered income, but they use their income to get this debt and then turn all that debt money into investment. So basically, the investments earn more than the interest on the debt. They're making bank, their tax rates all right, so easy to write off. Almost all their money comes from stuff that is very tax write-offable. They get fringe benefits from the businesses, and they're freaking set. They're really set. Most people can't afford to do that, and most people don't know how to do that. There's just, unfortunately, loopholes for the wealthy when it comes to taxes. There's very massive loopholes for corporations when it comes to tax. One thing I can say for an average person, don't limit yourself on your earning potential because you're afraid of tax brackets.